You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Ibstock, Just Eat, Greggs, Dominos, Quilter, StoneCo, and our book review, Fooled by Randomness. First on the list, we've got Ibstock, which released their full year results. And for anybody who doesn't know, Ibstock is the UK's largest brick maker, listed on the FTSE 250. So the results, they announced full year revenues falling 23% to 316 million. Underlying profits before tax down 86% to 12 million. Clay revenues down 29% to 213.2 million. There's a steep reduction in revenue and high fixed costs from early 2020, offset this with an EBITDA falling 59% to 44 million. Concrete revenues were 5.3% lower at 103 million, and underlying cash profits fell 31% to 15 million. However, the group did report a steady and sustained recovery in demand in the second half of 2020, with revenues of 90% of levels compared with the fourth quarter of 2019. The group also announced that the dividends would be resumed with a final dividend of 1.6p per share. That is lower than the 6.5% dividend for 2019, which was cancelled. The new dividend is approximately 2.5 times underlying earnings, and overall margins rose to just over 30% in the final months of the year. When the results were released, there was a fairly muted response on the markets and the shares didn't move particularly. The last time that we discussed Ibstock was back in October, and we looked at the first half year results of 2020. And in the first half results, the revenues were down 36% to 131 million, with an underlying loss before tax of 11 million, compared with 42 million pound profit in 2019. And production actually stopped in March and didn't restart until late May, when the coronavirus lockdown was released. And back then we were quite concerned about the net debt, which stood at 103 million pounds in the first half, and that was up 66% on 2019. And it was about 1.6 times the cash profits. And interestingly, at the time, we were also concerned, because we'd been released from the first lockdown, of what a second lockdown might be. But, you know, things in the third quarter when we were discussing it had been improving. And I mean, since then, Sam, I don't know what you think of these initial results, but we have seen the sort of a very promising vaccine rollout, which has changed the market completely, and there's sort of been, well, I suppose, a return to normality on the horizon. And it's done wonders for the share price of Ibstock and, you know, the market as a whole. I think we could answer some of those questions in terms of the figures that they've released since we last discussed it, and that net debt now stands at 69.2 million, which is about 1.5 times cash profits. And they had taken some measures to sort of, well, cost reductions. They'd shut down 3 factories and mothballed a 4th, and they'd announced a number of redundancies. And for comparison, back in 2019, the debt stood at 84.9 million, which was about 0.7 times cash profits. And the company have said that they're aiming for a further 20 million pounds of cost savings in 2021. And guiding for 2021, Ibstock have said that they expect cash profits to come in at 93 million pounds, and that would leave the company with a forward price to earnings ratio of 9.5. And historically, since being listed in 2015, it's been about 12.5, with a prospective dividend yield of about 2.5%. What do you think of these results and where Ibstock stands now and going forward?
I mean, I am actually speaking as a shareholder, but
That's okay.
I like these results. I thought the net debt was, to get the net debt down, I was very pleased with that. I mean, realistically, if you're making bricks and everything grinds to a halt, you're going to be losing money. There's not there's not really anything you can do about that. But I think the business itself is in very good shape. I think it's an excellent business. And I think a lot of the cost savings, so they've actually said a lot of the factory closures and the cost saving measures they've put in place, they don't believe it will impact their ability to get back to 2019 capacity. So, I mean, if they do get back to 2019 levels, they'll still have the benefit of those cost savings. It's not come at a result of capacity in any way. There were a few interesting points from the slides that I thought were worth talking about, so I'll just go through those. So on one of the slides, they show the revenue as a percentage of the 2019 comparative. So for Q1 of 2020, it was almost 100% of the comparative. In about April, it then drops to about 20%. May, probably about a third. And then June, it's getting close to 75%. But those are 3 months where that's a huge reduction in volume. So there's obviously going to be an impact. So it's not really concerning for me. In terms of the 2021 guidance, they said that they're expecting clay sales volumes for 2021 to be about 85% of 2019. And concrete volumes are expected to be modestly below 2019 levels. They actually mentioned that they're going to be repaying and expensing £2 million of furlough cash, or the repayment of £2 million of furlough cash will be expensed for 2021. My personal view, given how badly they have been affected, they have cancelled the dividend, they have had to make layoffs. My personal view is when you look at these results, they've clearly been impacted, and my thoughts as a shareholder is that they're perfectly entitled to that furlough cash. So I don't really understand why it's been repaid, to be honest.
No, and they're listed on the FTSE 250, and they're not a company that's under that much public scrutiny in comparison with, a Persimmon, for example, or a Taylor Wimpey.
I just think, given the year they've had, they were perfectly entitled to the cash. I don't think there's any need for that to have been repaid. But
that's right, and you can't imagine it as a debate at the dinner table.
You look at those results. Profits down 80%. The dividend's been slashed. I know it's just been reinstated, but it's a fraction of what it was. They have suffered. They said there was domestic clay brick production in 2020 of about 1.4 billion bricks, and that was 30% below the 2019 levels. And they've highlighted some of the strengths of their business. So they've said that they are the number one UK brick maker by production capacity, number one UK brickwork, specials and masonry fabrication company by production capacity, and they're the number one UK concrete floor beam manufacturer by production capacity. They've highlighted that their UK clay reserves are unrivaled, and they've got a unique and diversified asset base. Their earnings before interest, tax, depreciation and amortization margin averaged over 29% between 2016 and 2019. And the return on capital employed averaged 20% for those years. And in the last 5 years, they've generated more than £200 million of free cash flow. And they've basically shown the UK brick market from 2009 to 2020. And in 2020, the UK brick market consumed about 1.88 billion bricks, and that compares to 2.45 billion in 2019. And imports, it's something I talked about last time, but the UK, we actually import about 20% of our bricks because we don't have enough domestic capacity. So that's very, very good for Ibstock, because basically any bricks they can produce are probably going to get sold, really. But imports fell in 2020 to 340 million, and that was down from 460 million in 2019. And the imports represented 18% of the total brick market. And interestingly, they mentioned that the 3 largest UK brick manufacturers make up for about 90% of the manufacturing capacity in the UK. In terms of the valuation, I know you mentioned that they're basically trading at a forward PE of about 9. They're actually they're currently on an adjusted PE ratio of 54, but that's with those profits that were down 86%. If you were to take the normalized 2019 earnings, you'd get the normalized PE ratio is actually about 12. The forward PE ratio of 9, I think that's for a number of reasons, one of which is the cost savings they've put in place that would actually stick around if revenues return to 2019 levels. So, I like it. I thought it was a good year given the circumstances, and I like the business, and I like the industry.
Yeah, and I suppose the other things that were quite positive came from the budget and the extension of Help to Buy and the extension of the stamp duty holiday too, which can only really help Ibstock.
Yeah, anything that's going to lead to more houses being built, they're going to benefit from.
Yeah, and I suppose the other thing in comparison with the house builders themselves are Ibstock isn't as sensitive to the house prices as a house builder would be.
What's your view on Ibstock then?
I like Ibstock actually. Would I buy it? Possibly, but I have a house builder. I think we did discuss it last time. You can certainly own both. But no, I think going forward, I'm quite optimistic about the recovery from COVID and I suppose that the housing sector, which I guess Ibstock fits into, having a rosy future, certainly in the near term. So yeah, well-run business, reducing their debt. Any concerns about the stock? Anything that you'd...
I mean, my main concern last time was the debt. My only concern would be if we return to 2019 levels and it turns out that if it turns out that the factory closures means they can't get back to 2019 capacity, that would be a bit frustrating. But I have no reason to not believe management when they say that they don't believe their capacity will be impacted. So no, I'm very happy with it.
Good. So you weren't tempted to sell it at any point?
No. I mean, I'm only I think I was a fairly recent shareholder.
Mm-hmm. Did you buy before coronavirus or after? During?
I can't remember exactly when I bought, but I'm up about 35%. So I must have bought near the lows.
Okay, so like during the pandemic.
Yeah, I'll just work out. Yeah, I must have bought at about £1.60 a share. And it looks like it bottomed at about £1.38. So I didn't quite catch the bottom, but I got it at a pretty good price, I think.
Yeah, very good. So the next company we have is Just Eat. Sam, what were the results from Just Eat?
Yeah, so Just Eat, or Just Eat Takeaway, as it's now known, following their merger with the Dutch company Takeaway.com in April 2020, have come out with their full-year results. It is their first year of results as the combined entity. I'll just go over the history of the two companies. So Just Eat in 2001 launched in Denmark, and they actually then launched in the UK in 2006, and that was when they moved to the UK, their HQ. IPO'd on the London Stock Exchange in 2014. They acquired Menalog in Australia in 2015. They acquired Skip the Dishes in Canada in 2016, and they acquired Hungry House in the UK in 2018. I have no idea how that was allowed, but because that basically just turned them into a monopoly, didn't it, in the UK?
Yeah.
And Takeaway.com started life in 2000 as, I'm not going to try and pronounce it, but it's spelled THUISBEZORGD.NL. That was the original name. And they first expanded internationally in 2007 with entry into Germany and Belgium. In 2011, they changed the name to Takeaway.com. In 2014, they acquired two more websites. Two more companies I won't try and pronounce. In 2016, they IPO'd in Amsterdam. 2018, they acquired Tenbiz in Israel. And in 2019, they acquired Lieferheld, Pizza.de, and Foodora from Delivery Hero. And in April 2020, the all-share combination of Just Eat and Takeaway.com led to a listing on the London Stock Exchange as Just Eat Takeaway. I think they're also dual listed in Holland as well, actually. Yeah, so that's how the two companies came to be where they are. So they have now come out with their full year results, and it's, like I say, it's the first year of the combined entity following the merger. I think it was technically a takeover of Just Eat by Takeaway.com, but they were very similar sizes, so I guess it doesn't really matter whether you think of it as a merger or a takeover. Yeah, so the full year 2020 results, and all these figures are in euros. Revenue increased 54% to 2.4 billion euros, and they had adjusted earnings before interest, tax, depreciation, and amortization of 256 million euros. The CEO, Jitse Groen, said 2020 was an exceptional year for Just Eat Takeaway.com. Right before the completion of the merger between Just Eat and Takeaway.com, the world was hit by COVID-19. This brought unprecedented challenges to our restaurants, consumers, as well as our organization and staff. but it also created tailwinds for our business. In the second half of the year, we increased our investments into the legacy Just Eat business significantly, building on our position as one of the largest food delivery companies in the world. Our revenue grew 54% in 2020, and we expect a further acceleration of our order growth in 2021 compared with last year. So some of the highlights: the company reported 3 consecutive quarters of order growth acceleration in 2020. And as a result, Just Eat Takeaway.com processed 588 million orders in 2020, which represented a 42% increase with 2019. Revenue on a combined basis grew 54% to 2.4 billion euros, compared with 1.6 billion euros in 2019. Adjusted earnings before interest, tax, depreciation and amortization increased to 256 million euros, which was up 18% from 217 million euros in 2019. And this strong improvement was mainly driven by strong growth in Germany, Canada and the Netherlands. The share of delivery orders increased to 26% in 2020, up from 18% in 2019. And that represented year-on-year order growth of 107%. In the fourth quarter of 2020, the year-on-year growth rate of delivery orders reached 163%. Despite competitively low delivery fees, the delivery business generated positive revenue less fulfillment costs in 2020. Operational efficiency continuously improved, and management deliberately implemented a price leadership strategy to win market share. The company believes that only clear market leadership positions will lead to sufficient scale, high order density and network effect, which enable healthy delivery margins in the long run. We will come back to that belief later on, actually. Just Eat Takeaway.com is a clear market leader in the UK in terms of orders. In addition to strong growth in marketplace orders, the growth rate of its delivery business is multiple times the growth rate of its competitors. This has been further demonstrated in the first 2 months of 2021, with UK orders up 88% and delivery orders up more than 600% compared with the first 2 months of 2020. Given recent trading and the investment programme, management expects increased market share in the UK in 2021. The loss for the period on an IFRS basis was 151 million euros, compared with a loss of 115 million euros in 2019. The loss was driven by amortization and non-recurring expenses, such as advisory and integration costs, of which 102 million is connected with the combination of Just Eat and Takeaway.com, and the proposed transaction with Grubhub. In Brazil, investments in iFood returned excellent revenue growth of 222% for the full year. Order growth doubled year on year and reached 478 million orders in 2020. The strength of the fast-growing asset is reflected in its improved adjusted EBITDA margin. Management has previously expressed its willingness to monetize its 33% stake in iFood if an appropriate offer is made that reflects the size and superior growth of this asset. Management has turned down several bids, the highest of which amounted to 2.3 billion euros to date. On 10th of June 2020, the company announced a proposal of an all-share transaction with Grubhub, subject to satisfaction of conditions, including the approval of the registration statement and prospectus by the relevant authorities. Completion of the transaction is anticipated to occur in the first half of 2021. We'll get back to it later, but Grubhub is one of the players in the US. On 2nd of February 2021, Just Eat Takeaway.com successfully raised 1.1 billion euros through an offering of convertible bonds at attractive funding terms to retain the financial and strategic flexibility which comes from a strong balance sheet. I'll just go through some of the figures. Although the merger didn't take place until April 2020, they've combined the two companies for the full year for the basis of the comparative. So these are genuine comparative figures. They're not distorted by anything. So number of restaurants was up 42% from 173,000 to 244,000. Number of active customers was up 23% from 48 million to 60 million. Returning active customers as a percentage of active customers was up from 68% to 70%. Orders per returning active customer was up from 13.2 to 15.2. Total orders was up 42% from 413 million to 588 million. And the breakdown by segment, and the segments, by the way, broken up into UK, Germany, Canada, Netherlands, and rest of the world. And UK orders up 35% from 133 million to 179 million. Germany orders up 69% to 112 million. Canada orders up 78% to 86 million. Netherlands up 30% to 49 million. And rest of the world up 29% to 162 million. The average order value was up from 29.69 euros to 22 euros. And the gross merchandise volume was up 51% from 8.6 billion to 12.9 billion. So in terms of revenue, this was up 54% from 1.5 billion to 2.398 billion. And that's made up of revenue growth in the UK of 42% to 725 million, in Germany of 82% to 374 million, in Canada of 59% to 515 million, in the Netherlands of 47% to 174 million, in the rest of the world of 53% to 610 million, and adjusted EBITDA was up 18% to 256 million, as mentioned earlier. It feels a bit like covering the US companies, doesn't it? The countries included in the rest of the world segment are Australia, Austria, Belgium, Bulgaria, Denmark, France, Ireland, Israel, Italy, Luxembourg, New Zealand, Norway, Poland, Portugal, Romania, Spain, and Switzerland. Okay, so there are some other things as well in the slides that I thought were quite interesting. So gross profit for the year, and that's on revenue of 2.4 billion. Gross profit was 1.3 billion, which was up 33%. So that gives a gross profit margin of 54%. Marketing spend was 437 million, and that was up 38% year over year. And the marketing spend as a proportion of revenue is 18%, and that was actually down 2% year over year. As mentioned earlier, they've received multiple offers for the stake in iFood with 2.3 billion, the highest to date. However, they don't believe that reflects a fair value. So iFood it's technically Latin America, but it's mainly Brazil. So it's the Brazilian side of the business. Excluding Brazil and Colombia, they believe they've only reached 13% population, and that's out of addressable population of 450 million. Interesting, they did point out that their Australian full year order growth was 104%. And they've also put some graphs in that split the cohorts from the year that they made their first order. And what it shows is the longer a cohort is on the platform, the larger their revenues generally become. So they're collecting more from each cohort each year, and the majority of the orders are coming from the existing cohorts rather than just from the new customers. So there's not a very high level of churn. In terms of the valuation, there's no earnings, so we can't do a PE ratio. If we were to look at a price to sales, the price to sales is 6. And if we were to take the price of the adjusted EBITDA, that would give the closest thing we can get to a PE ratio, and that would give a ratio of 48. I don't think that's outrageous given the levels of growth. I like the valuation. I like the combined business. I like it a lot more than I expected to, actually. I think it's a good business. I think it's a very interesting business. Certainly from my experience of using the UK part of the business, I think it is an excellent product. My biggest issue with this business is the proposed acquisition of Grubhub. So as they mentioned earlier, their key belief is that they need the strategies to basically get the dominant position in each market, because that's how you get the economies of scale. However, Grubhub, which they have agreed to acquire, does not have a dominant position. In 2020, it lost $147 million on 1.8 billion of revenue. And Grubhub doesn't seem like a terrible business, but it's the delivery aspect that concerns me. So I'll just read from an article I found on businessofapps.com. And that says Grubhub still generates most of its revenue through non-delivery orders. However, delivery has become a larger part of the business. In 2019, the company posted its first ever yearly loss, which it blamed on its delivery services in the competitive market. Since 2015, Grubhub has steadily lost market share in the US as Uber Eats and DoorDash claimed more users. From a high of 70%, Grubhub sits at less than 20% market share in 2020, behind DoorDash at 45% and Uber Eats with Postmates at 30%. In 2020, Uber approached Grubhub with an acquisition offer after failing to acquire DoorDash. At the same time, Just Eat Takeaway launched a $7.1 billion bid, which Grubhub accepted in June 2020. The acquisition adds a new source of funding for Grubhub to continue competing with DoorDash and Uber Eats in the rather low margin market for food delivery. The combined company, so that would be Just Eat Takeaway and Grubhub, generated $3 billion in revenue in 2019, which would make it the largest food delivery operator in the West. My concern is that they're spending a lot of money to acquire a business that is the third biggest player and is losing market share. And not only that, I understand that the combined business will be rather large, but I wouldn't want to in that position go up against Uber Eats and DoorDash. If I was Just Eat Takeaway, or if I was a Just Eat Takeaway shareholder, I would much prefer them to just be staying out of the US market altogether, rather than try and turn around a company that's gone from 70% market share to less than 20%. John, what are your thoughts on Just Eat Takeaway?
I think probably similar to you. I think I'd definitely be concerned about the Grubhub. How far along has that gone? Do we know?
It's been agreed. So it's just,
okay.
It's good. It should be going through in the first half of this year.
And I suppose even in the UK, which is its main market, it's got, well, Deliveroo is going to be floated possibly in the next couple of months. And the huge competition from Deliveroo. What are the margins on the business?
Gross margin was 54%. I think that was actually down. I think the margin had come down year over year. But yeah, gross margin is 54%. There's no operating margins because it's not making a profit.
Sure.
And I mean, your guess is as good as mine as to what level of profit margins it could feed into in the future. I don't see any reason why, for just the app itself and the service it's providing, that couldn't be quite high. My concern is the delivery, because delivery, it's not high margin. It's very competitive.
Yeah.
And it just seems to me like they're going into delivery because everyone else is doing it. And they have to offer delivery, because otherwise people will just list on a platform that does offer it. But I could see delivery really, the bigger it gets, just really eating into the margins and really affecting the attractiveness of the business, like has happened with Grubhub.
Yeah.
But,
no, I'm not keen on it, to be honest, as an investment. I mean, I use it as a customer. Well, I was using Deliveroo as well. I certainly think in terms of the user interface on the app, Just Eat's got much better. So I think in the past it was maybe a little bit clunky, but now they accept Apple Pay and it's all a bit smoother on the UI. But no, I think as an investment, I wouldn't be keen. I mean, you owned it at one point, Sam.
I did own it I owned it for a very short period. It must have been fairly recently, but I bought it just before Takeaway made the first offer. Like, we're talking like a week or something. So Takeaway made the first offer and it shot up about 30% in a day, because it was obviously the price went up to the offer price. I was comfortable with Just Eat. I didn't know anything about Takeaway. And because I'd just bought and it had gone up like 30% in a week, my thoughts were, this isn't what I signed up for. I didn't want to do a load of additional research on Takeaway because I didn't really understand it. I didn't know the business. So I just took the money and ran. This is the first time I've actually looked at the combined entity since selling my Just Eat shares. But I like the combined entity. It is just a Grubhub acquisition that, for me, really sours it, to be honest.
Yeah, and I mean, I think it's possibly reflected in the share price, and certainly year-to-date return is minus 16%.
Which is surprising when you look at the revenue figures and...
Yeah, exactly. But I think it's probably those concerns that you've expressed reflected in the price, I would have thought.
Would you be interested in it if it wasn't for the Grubhub acquisition?
I quite like it to be, to have earnings before I looked at it. But
so old-fashioned. Price sales of 6 with those figures, it probably would have made my watch list. It probably would have gone on the watch list, but it won't be. It won't. Yeah, I'm not. Okay. I've no interest in Grubhub.
Okay, fine. Next, we've got Greggs. So again, now this certainly isn't an international business. It's the UK. I think it's the largest bakery chain, and they announced their full year results, which were the first loss that they'd made as a public company. But looking at the share price, you wouldn't know it, that's for sure. So for the 53 weeks to the end of the 2nd of January 2021, the company had a pre-tax loss of 13.7 million. And that's including the government job retention and business rate relief. And that compares with a profit of 108.3 million in 2019. Total sales were down 30.5% to 811 million, compared with 1.16 billion pounds in 2019. And they ended the year with a positive cash position and additional liquidity available under a new £100 million revolving credit facility. They're very slightly better than the company had guided back in January, when it expected a pre-tax loss for the year to be up to £15 million. On the more positive side, Greg said that they made progress in the second half with shops reopening and click and collect service made available at 600 of its roughly 2,000 stores, and delivery, which was actually in partnership with Just Eat, accounting for 5.5% of company managed shop sales. If we break 2020 down a little bit more, Greg suffered a £65.2 million loss in the first half, with a 3-month closure of the shop estate, followed by a £51.5 million profit in the second half. So really a year of two halves. And you can see actually, and I guess this is reflected in the share price, how positive the rebound was in the second half after lockdown was released. They also said that they were planning for 100 new shops opening in 2021, and they were going to capitalize on the growing trend of vegan friendly lines, adding to their existing range with the vegan sausage rolls, and further expansion in the south, which is, I mean, if anyone's sort of living in the UK, you'll know if you go to the north, there are Greggs everywhere. It's not the same in the south. You've got more of your Pretts, but Greggs are moving to open more stores in the south. Is Greggs a company you like, Sam? And in terms of these results, especially the second half, how do you see Greggs going forward?
I do like the company. So we covered it before, and we did. So we covered it after it released its 6-month results to July 20. And we did actually comment at the time that we thought about, at that point, the sales had bounced back to 76% of the prior year. And we were surprised by how impressive that was. And I don't know exactly when we covered it. I think it was one of the earlier episodes, but it looks like it's up about 50 or 60% at least since then. I think it must have been about £14 a share when we covered it. I like the business, but it has been hit hard, and I wouldn't be buying it at share price levels that are pretty much in line with pre-pandemic levels, when it's not got to a post-pandemic state yet. It is still very much suffering. It's very much been affected by the pandemic. And although the rebound's been strong, it is still recovering. And I'd expect that to be reflected in the share price. Yeah, I wouldn't enter at these prices because it's priced as if everything's gone back to normal already when it hasn't.
The shares, since we had the positive news from Pfizer in September, the shares are up 84%. And like you say, in terms of, I think an all-time high for Greg shares were about £24, and it's currently hovering around the £20 mark. So yeah, like you say, it's priced as though the recovery has happened already.
And as well, so there are a few things from the slides I thought were quite interesting. One of them is 56% of their shops currently are high street shops. And just as a long-term trend, that's not necessarily a good thing. Although I do like Greggs, and I certainly wouldn't bet against it, but I think I would expect the high street to decline long term. So having the majority of their shops as high street shops, it's not fantastic. They are still like a high street brand, really, aren't they? They've set a target of increasing the number of shops from 2,078 to 3,000. Presumably that's going to be mainly by expanding into the south, as you've mentioned, because I mean, if you walk down a northern high street, you can't cross the road.
There's no room for any more Greggs,
Yeah, so they must be in the south, but they want at least 800 of those shops to offer delivery. And in 2020, they actually opened 84 new shops and closed 56. And they've started doing delivery now, as you said, with Just Eat. And in Q4 2020, 5.5% of sales were delivery sales, but that's in the first 10 weeks of 2021, that's gone up to 9.6%. So they are starting, I can see people wanting Greggs delivery. I don't think it's something where, like, if you sat there at home ordering a takeaway from Just Eat for your dinner, I don't think you do necessarily pick a Greggs. But I think if you're at work at lunchtime, you could get Greggs delivered to the office. I think that's quite attractive. So I do see that. They split out the costs as well. So 40% of their costs are to do with people, 8% are shop occupancy, 29% are food and packaging, 4% are energy and fuel, 6% are depreciation, 13% of it's just what's under other costs. But no, I do like the business. I think it's a robust business. I think the percentage of high street stores is concerning, but I wouldn't bet against them given their popularity. And I do think delivery is a realistic option for them. It is just the price now.
Yeah, I suppose, yes, they are sort of high street retail, almost high street retail, but they're not a high street retailer in the sense that they're a Comet or a Currys, and they're going to, I would have thought, be less impacted by, I suppose, e-commerce, really.
It's not so much e-commerce; it's the falling foot traffic to other.
Okay. So I suppose it would be if you went along the reasoning that high streets might be repurposed, or it might be more an experience-based sort of high street rather than traditional sort of shopping in national chain stores, then I suppose on that basis, Greggs would have a place. But I guess that's a big if.
I think as long as there's people on the high street, whatever form that is, Greggs would be fine. But if all these other shops that are impacted by e-commerce start to move away and they're not replaced by anything, that's when Greggs has a problem.
Yeah.
I guess you then have into the argument then of, well, can they offset that with rising delivery anyway? So although they might have fewer sales in the high street stores, if they're delivering to nearby offices and stuff like that, then it might not be a problem. But I don't know.
No, I don't know. And I don't think I'd be, well, no, I know I wouldn't be buying in at the moment. But I think probably over the course of the next year, see whether things do return to pre-pandemic and whether they can grow anything.
It is a quality business, though, and it is one that at the right price, I would definitely be interested in.
No, absolutely. I would agree with you there. And certainly over the years, it smashed the index. I think if I look at the last 10 years, it must be 300+%.
No, it's up 96% in 5 years.
Okay, so Domino's, Sam?
Yep.
Continuing the theme?
Yeah, Domino's have released, I actually did some market research into Domino's earlier this week as part of the prep for the podcast. But,
and what did you find?
I continue to be annoyed by the fact that I live just outside the delivery radius. Don't collect it, but that's my only real complaint. So Domino's, do you know that only 9% of Domino's orders are full price orders? 91% are on some kind of deal.
I suspected, but I didn't know. That's higher than I thought it would be, actually.
It's higher than I thought it'd be, but
I thought there would be some, there might be 30 or 40% of people who are paying full price.
People are too wise, aren't they? They know. But I guess there's always some kind of deal on, even if it's not like a particularly good deal. Right. So they've come out with their full year results, and sales were up from 1.2 billion to 1.348 billion. And that represented like-for-like sales growth of 10.3%. The earnings before interest and tax was up 3.5% to 109 million. Underlying profit before tax was up 2.4% to 101.2 million. Underlying basic earnings per share was up 3.4% to 18.2p a share. And the net debt was down 26.1% to 171.8 million. In the financial highlights, they've highlighted they incurred COVID-19 costs of £9 million to support franchisees to trade safely. Free cash flow increased by 73% to 99 million. They announced a £45 million share buyback programme effective imminently in line with new capital allocation philosophy and commitment to distribute surplus capital to shareholders. They announced a total dividend for the full year of 9.1p per share to be paid on the 4th of May. It represents a yield of about 2.5% of the current share price. They've said that digital transformation of the business accelerated through the year. UK online sales were up 23.9% and app sales were up 26.2%. And online sales now account for 94.3% of delivery sales in the UK. The disposal of the discontinued international operations is progressing, with the Norway disposal completed in May 2020, contract exchange on the disposal of Sweden, completion expected in May 21, and the Iceland and Switzerland disposal processes are ongoing. So for anyone who's not followed the business before, the UK and Ireland side of the business has historically been very profitable, and then they've also got businesses in a few Scandinavian countries that have basically just been a bit of a drag on earnings for a number of years now, and they've finally decided to get rid of those fairly recently. In the presentation, they highlighted that they've made an attractive offer to Domino's franchisees to seek alignment and accelerate growth. They've highlighted that for their own stores, the average EBITDA was up from 145k a store to 229k a store, and the EBITDA margin increased from 14 to 20%. On the franchisee level, the average EBITDA was up from 110k per store to 191k per store, and the EBITDA margin was up from 11% to 17%. For the year, total sales, delivery sales were up 23.7%, and collection sales were down 34.3%. And for total orders, delivery was up 10.3% and collection was down 41.9%. They said the full year order count declined by 6% as collection closed in Q2. Collection was trading at about 60% of 2019 levels in the second half of the year. They've highlighted that they acquired 5 million new digital customers in the year. Overall customer satisfaction was up to 69% from 61% during the year. I'm actually surprised it's that low, to be honest. I thought it'd be higher. And their net promoter score improved by 10 points from 45 to 55 during the year. They've highlighted that they've engaged with their franchisees in the development of their strategic plans, and they've made an attractive offer to Domino's franchisees representatives to align their strategic and financial interests with theirs, which includes an enhanced food rebate to drive growth, new store incentives to encourage openings, material capital investment in the digital platform, customer relationship management and the supply chain, capability investment in marketing effectiveness, data and insights, a modest increase in the National Advertising Fund contribution, aligned to enhance marketing effectiveness and participation in national details. So this goes to an issue that's been going on for a couple of years now with franchisees, where a lot of Domino's profits actually comes from the margins. So when you set up a Domino's franchise, you have to buy all your food and all your stuff from Domino's. That's part of the agreement. And a lot of the franchisees are complaining that the margins that Domino's makes on these products, like the cheese and stuff, are just far too high. What happens in the UK is a small number of franchisees actually control a large number of the franchises, so they do have quite a lot of negotiating power. And so there have been talks going on for a while now to try and get to a situation where everyone's happy. Another problem is that because Domino's have been trying to drive growth, one way they've been doing that is by opening new stores in areas where maybe existing stores already exist. So although the total sales might be increasing in an area, there's possibly some cannibalization going on between the existing stores already owned by franchisees. So this is an ongoing problem for the franchisees. However, as we highlighted earlier, the difference between the EBITDA margins from an owned store and a franchisee store, it's only 3%.
There's not a lot.
It's not, no. But then I guess you'd maybe look at it and say, well, the average EBITDA per store is almost 40k higher in the owned store. But no, it's a difficult one. I think Domino's need to play ball with the franchisees, but really the franchisees, they knew what they were signing up for. Like there's not a huge amount. I mean, Domino's can like throw them a bone, but I don't know, there's not a huge amount. You want everyone getting along though. They've set a target to grow sales from 1.6 billion to 1.9 billion, and that includes 200 new store openings. So I'm not sure what the franchisees will think about that either.
Depends where you open them.
It does, yeah. And then in terms of the store numbers, the store number of stores rose from 1,130 to 1,147, and the franchise stores make up 1,110 of those, and the corporate stores only make up 37 of those. So in terms of the valuation, the company's trading at a market cap of 1.71 billion, PE ratio of about 20, and dividend yield of about 2.5%. John, thoughts on Domino's?
I suppose out of the three that we've discussed, Greggs, Domino's, or Greggs, Just Eat and Domino's, I'd probably be leaning towards Domino's. And I'd say in terms of the valuation as well, it's the cheapest it's been in quite some time. I think if we look back, if we look at the last 5 years, the price to earnings ratio has come down from about 85 in 2015, and it's sort of fallen every year. And apart from 2018 to 2019, where it went up slightly, but it was trading at 25 times earnings in 2019, and now we're 20 times earnings. I'd say it's a very high quality business, and it's not historically as expensive as it has been. I don't know whether that's because of increased competition from other takeaways in Deliveroo and Domino's being a sort of an independent franchise, or whether it's the sort of the trouble with the franchisees, whether that's sort of depressing the price. But I certainly think the numbers were good.
I'm in agreement. I think it's definitely a quality business. And then if you actually look at the share price, I mean, in 5 years, they've barely moved. It's barely budged. And it's up about just under 8% in 5 years. I don't know if it's maybe a case of it was growing a lot more earlier on, and then it's got to a valuation that it's grown into. But well, like, I mean, look at the revenue 5 years ago. Revenue was 360 million. It's now up to 500 million.
Yeah.
Earnings per share was 13p. That's up to 17.8p. I mean, the business has improved substantially in those 5 years, and the share price hasn't budged. And I think it's a high quality business at quite a fair valuation.
Yeah. I wonder whether the market feels it's fully valued, and not looking for, or not price. It's certainly not priced for huge growth.
No, but
or maybe the growth that it had delivered 20 years ago.
Oh, I forgot to mention they've got another 54 stores in the Republic of Ireland. So in total, they've got 1,201 stores. And if they're targeting another 200, and that's an increase of 17%. I mean, if you added another 200 stores into that, assuming that they're as profitable as the existing stores, I mean, that you're then potentially looking at a PE ratio that's, I mean, what would it be like? Maybe like 16, 17? It's
yeah.
I think it must be more to do with like the delivery side and Just Eat. I think it's more the Just Eats of the world that are causing it to have a slightly lower valuation, because it is a quality. 5 years ago, I don't think. Well, we could say you wouldn't have got it at a PE anywhere near 20.
No, yeah, you wouldn't. That's for sure. So yeah, is it one that you'd consider investing in?
It is, yeah, and I agree with what you said. Where of the three we've looked at, I'd definitely be picking Domino's.
Yeah. No,
I do like it, and I was surprised that customer satisfaction was only in the high 60s, because the app works seamlessly, or I think it does. I think it's all very slick. It's very easy to order, and then I've certainly had far fewer problems with Domino's as a proportion of my orders than I've had with Just Eat. I'm a very happy user of Just Eat, but they don't control the whole process like Domino's do, and I do think it reflects in more issues. I know I am very happy with Just Eat, but I'd expect Domino's have a higher proportion of satisfied customers than Just Eat do.
Yeah, it'll be interesting to cover Deliveroo when it goes public.
It will, yeah.
Yeah, early April 2021 potentially. Final UK company on the list is Quilter. Quilter, for anybody who doesn't know, is a UK-based wealth manager, which is listed on the FTSE 250, and they released their full year results on Wednesday. They announced an adjusted profit before tax, which was down 7.6% to £168 million from the £182 million in 2019. Adjusted diluted earnings per share down to 8.5p from 8.6p year on year. This reflected a reduced share count due to the capital return / share buyback program. Assets under management and administration were up 7% to the year end 31st of December 2020 to 117.8 billion, with net client cash flow increasing significantly to 1.6 billion from the 0.3 billion in 2019. Integrated net inflows totaled 2.3 billion in 2020, compared with 2.6 billion in 2019. And the company also announced that IFRS profit before tax attributable to equity holders from continuing operations came in at 50 million in 2020, compared with a 53 million pound loss in 2019. They also said that the company's operational efficiency delivered a reduction in full year operating expenses of £60 million, or 3%. That's in spite of incremental costs from acquisitions of around £12 million, higher FSCS levies and regulatory expenses of £7 million, and other costs headwinds included COVID-19 costs of around 5 million. Operating margin was about 25%, which was down slightly from 26% in 2019. And the chief executive, Paul Feeney, commented, "The successful completion of our platform transformation program is a significant milestone. It not only proves our organizational capability to manage a project on this scale safely, but also sets us up for more accelerated growth in the huge UK wealth market. We responded quickly to the changed COVID-19 environment in the second quarter by identifying tactical cost savings of £30 million and overachieved against this target, leading to a 3% decline in year-on-year costs, despite other meaningful expense headwinds." And he said that he was excited by the company's outlook in 2021 and beyond. "Since we listed in 2019, our focus has been on transforming Quilter into the business we planned, a modern UK-focused wealth manager built around the core tenets of trusted financial advice, value for money, responsible and sustainable investment solutions, and excellent customer service, all enabled and supported by the most advanced technology platform. Now, with significant progress made on our transformation, we are wholly focused on driving growth and efficiency through even better customer outcomes." And at the moment, Quilter has a market cap of about 2.75 billion. It's trading at a price to earnings of about 17.8, and it's got a dividend of about 3%, or a yield of about 3%. And on these results, the shares were up about 3% at £1.51. Sam, is there any? I mean, we've covered a few wealth managers over the past few weeks and, well, few months as well. How do you feel Quilter compares with your Rathbones and Schroders?
I mean, it's the PEs at a significant premium to Rathbones and Schroders. They were at about 12 when we covered them last week, and this is at almost 18. And I unless I'm missing something, I can't see anything in the results that would justify that. I felt like Rathbones and Schroders both had better results than Quilter, so I don't understand why it's trading at a premium.
No, that I think that's fair enough. I was looking for why it was why it was so much more expensive than what I would have thought would be sort of comparable, on the face of it, comparable businesses within the sector, and I couldn't see anything either. It may be one that I've missed something that they're doing or which the market has expected. I know that there was an offer mooted in early 2020 for it to be bought because it had been listed or it had been spun out of the Old Mutual in 2019 and floated or IPO'd. I think it had been a public company at points in the past, but it then went to Old Mutual as part of them and then spun off again, IPO'd in 2019. I think early 2020, there was a rumor that an American private equity group might be interested in buying it and taking it private again. So whether that's something that's still in the mix, I'm not sure, but it does seem for the sector quite expensive.
I wonder, the only thing I could think of was they do have a share buyback program, and it's fairly significant. I think they retired about 6% of the shares last year. So I guess maybe that people are pricing in the fact that there is capital being distributed to shareholders other than in the form of dividends. So that dividend, maybe if you're buying it for the income, you'll pay more of a premium because it's the dividend yield isn't the only thing you're judging it off. Maybe. I'd rather go with Rathbones or Schroders. I'd go with both of those over Quilter.
Yeah. And you have got that you have got those others available to you. So I think I'd be in the same boat there. But interesting is a relatively new public company, again, to just have a look at, and in a sector that we enjoy talking about on the podcast.
We certainly do.
Okay. So finally, our US company, StoneCo.
Yep. So our final company is StoneCo, and it's a Brazilian company listed in the US. So for anyone who doesn't know StoneCo, it's probably easiest to think of them as probably the Square or the PayPal of Latin America. I say Latin America, they're mainly Brazil based at the minute. So they have come out with their full year results, and the figures are all in Brazilian reals, which for anyone who doesn't know is equivalent to about 0.18 American dollars or 0.13 pounds sterling. So they've announced 209 billion payment volume, up 62.6% year over year. Total revenue and income, so their take of that payment volume was 3.32 billion reals, which was an increase of 28.9% year over year. Adjusted net margin of 28.9%. Net income of 837.4 million reals, which was up 4.1% year over year, and a basic earnings per share of 2.95 Brazilian reals per share, an increase of 1.9% year over year. They added 171,700 new clients this year, excluding their TON platform, which we'll get to in a bit, which takes the total number of clients up to 652,600, an increase of 35.7% year over year. And the adjusted free cash flow was 653.5 million reals, which was up 57.3% year over year. Oh, Berkshire Hathaway actually has a 5% ownership of this company, by the way.
What's the market cap?
It's now at $21 billion, but
okay.
It's had a very good year. It was probably more like 5. I reckon it's been at least a 4-bagger for Berkshire, possibly even more than that. I'd be surprised if it's Buffett that bought it. It's probably Todd or Ted, but in some of the highlights, they've talked about the fintech as a service and software solutions side of the business. And they've said digital small businesses accelerated revenue growth to 94% in the fourth quarter. They've got 387,600 software clients in December 2020, which was up 187% year over year and 13% quarter over quarter. And they reached 18.85% ownership of links through open market transactions, a lower average price per share than their offer. So Links is it's another Brazilian company, but it's publicly traded on the New York Stock Exchange. So it's a company that specializes in technology for the retail sector and apparently has a 45.6% market share for that market in Brazil. So StoneCo have made an offer to buy it, but they've been able to actually build up an 18% ownership of it anyway in the open market at a price below their offer price. And then in the financial platform for small, medium-sized businesses and TON, which is it's basically their platform to enable micro payments for merchants. So it's very small clients. They've highlighted accelerated total payment volume growth year over year of 45%. They've reached 508,200 open digital banking accounts in December 2020, which was an increase of 151,000 quarter over quarter. They've got 133,400 digital banking accounts actively being used as the merchant's main settlement account as of December 20. And the client base reached 113,700 micro merchants in December 2020, with 83% total payment volume growth and encouraging unit economics. They said they expect their active client base, excluding the micropayment side of the business, to reach 1 million clients by December 2021. We've highlighted that after launching in March 2020, TON ended 2020 with a client base of nearly 5x the end of the first quarter in 2020. And they've said that in 2021, they're looking to expand the ecosystem of solutions beyond payments with credit and insurance as a broker. In terms of the valuation, company does have earnings. So it trades at a PE ratio of 373 and a price to sales ratio of 36. It's an interesting business. However, I struggle to understand all the different components. I think it's partly because it is just entirely based in Brazil. It's not something I hear about at all. Whereas even with something like Square, which is mainly based in the US, at least you hear about it. And I'm aware of Square and what they're doing, even if they're not as prominent in the UK.
Out of interest, how does it compare on a valuation basis with Square?
Square's got a PE ratio of 532. So in PE ratios, they're not that far off. Market cap, Square's about 5 times bigger. And price to sales, Square's at about 10 or 11 compared to 36. But Square's price to sales, the problem with that is that it's basically useless because they enable Bitcoin trading on the platform. And if you buy a whole Bitcoin, that counts as... So say you buy a Bitcoin for $50,000, they put through revenue of $50,000, even though they only take about 1 or 2% of that as fees. So Square's price to sales looks a lot lower than it actually is, because if you strip out the Bitcoin, it would probably be a lot higher. But in terms of PE, you're looking at 500 versus 373. So I guess you could say they're fairly similar. But yeah, so with Square, like I can understand that a lot better. I guess because it's in America. Whereas with this, besides what they're telling me in the slides, I just have no idea how this business really works. So for me, it's an interesting business. It's the type of business I'd be typically interested in. But to pay a price of sales of 36 and a PE of 373, I'd really need to know what I was getting, and I would need to really be behind the business, basically. And I just can't do that because I don't understand it well enough. Goes in the too hard pile for me. What about you, John?
Yeah. I think it would probably be the same, but it's interesting nonetheless to have a look at it.
Yeah, it's just a shame it's so difficult to understand. I guess it's because you just don't have any context for what they say. Do you get what I mean?
Yeah. No, I do.
It's hard to picture it. Right, so of the 6 companies that we've talked about today, Ibstock, Just Eat Takeaway, Greggs, Dominos, Quilter and StoneCo. If you had to buy one, which one would you be going for?
I think it's tricky, actually. I think it would be between Ibstock and Dominos. Because I have a house builder, I might say if I had to pick between the two, I'd go for Dominos. But I think both of those caught my eye this week. What about you?
I'd probably go for Dominos. I own Ibstock. I like it. I'll continue to own it. But I thought Dominos was a quality business at a reasonable valuation, and a valuation that it doesn't normally trade at. So for me, Dominos just picked it.
Brilliant. Well,
right.
On that note, sorry. We've got the book review.
We've got the listener question as well.
Oh, right. Yes. Go. Which should we do first?
We'll do the book review first. So it's going to be quite quick.
Okay.
Today. So the book is Fooled by Randomness, The Hidden Role of Chance in Life and in the Markets by Nassim Nicholas Taleb. Basically, the book explains how we underestimate the role of luck in successful people, and we also underestimate the role of luck in unsuccessful people. So an example he comes back to throughout the book is that when you see traders that have really, for example, like maybe traders in specialized in like emerging market bonds in the 1990s before they all blew up. A lot of it's just that they were in the right place at the right time, and then once that strategy no longer works, they're unable to adapt. And really, it's just luck, because people who were trading the exact same things in the exact same way 10 or 15 years earlier, before there was a big run-up, didn't have the kinds of returns they do. And one of the key points in the book is really that a lot of people are in the right place at the right time, and we don't give enough credit to that. We actually just look at it and it's almost like we'll believe whatever people tell them about. Basically, people attribute the reason they're successful to their exact personality, and then people try and replicate that, and they just don't appreciate that there is a lot of luck involved. And it's not all of them, but a lot of people who are successful, especially with something like trading, they take a large amount of risk that happens to pay off, and you don't see all the people where it doesn't pay off for them because they're not talked about. So an example would be fund managers, where obviously most fund managers do not outperform the market in the long term, but in a given year, a certain number of them will, and in a number of years, a certain number of them will have good returns versus the market. And he says that we give too much weight to their returns, because if you look at them as a cohort of the total number of funds, you would expect a small number to outperform. So it doesn't necessarily mean it's because they're doing something special. It possibly just means they were the lucky few that did. And one of the key takeaways is he talks about how if you take a successful person, if you were to replay the exact scenario of their life 1,000 times, in how many of those 1,000 run-throughs would you expect them to be successful? And he says, if you actually look at it with their behaviors and their attitude toward risk-taking, the majority of the time you would expect that person to blow up at some point. And really, they've just got lucky on this one time. And then he relates it to investing. He basically talks about his trading strategy. So he's actually an options trader. And his whole strategy for investing is to avoid getting blown up by what he calls black swan events. So a good example of a black swan event would actually be coronavirus, where it's this call it a once in a century event. And because no one remembers if you'd been trading in 1918 when you had Spanish influenza, you might have remembered the effect it had on the markets, and it might have been something that you prepared for. But because it's not in anyone's living memory, or no one was prepared for a pandemic and the impact it would have on stock markets in March, he talks about how in situations like that, he basically positions his trades so that he loses money most of the time, and then when something like that black swan event happens, he's set up to capitalize on that. It's an interesting read, but he's very opinionated, and I certainly don't agree with everything in the book. So as an example, there's another book that's fairly well known called The Millionaire Next Door, and it's a study of let's just say 2,000 or 3,000 millionaires in America. And it looks at their habits and what they've got in common, with the idea being that you can look at if they've all got certain traits in common, it's probably fair to deduce, especially if they're all self-made millionaires, that those traits, if you have them, are more likely to make you a millionaire. And he actually talks about this book in his book and basically says, well, all these millionaires are just the lucky ones, and the author doesn't really appreciate that. And I don't really agree with it. I think he's got an interesting line of thinking, but he just takes it to the most extreme possible version, when I think in reality there are certain things you can do that are more likely to improve your results in investing and in life. So to just he's almost on the side of efficient market hypothesis, or he's saying it's just all down to luck. So I certainly just don't agree with that, but it is an interesting read.
Interesting. An interesting argument to make, but not one that I haven't read the book, but that I think I'd be convinced by.
Yeah, and then we've also got a listener question before we finish from Imagine Invest, and he asks, thinking of the new UK tax year and stocks and shares ISA subscriptions, what platforms are you using or considering for your investments, and what research tools do you use for stock ideas, news, data, etc.?
Shall I start by the platform, Sam?
Yeah, can do.
So the platforms, I use a few different platforms, and I suppose they serve different purposes. So I've got a lifetime ISA and a regular ISA. Most of what I invest in are indexes. So I like the Vanguard platform for that. Obviously, it is just the Vanguard funds that you can buy through it, but I think they are very good. So for example, if you wanted to buy the S&P 500 as an ETF, or FTSE 100 All World Index, you can do that, and there are no trading fees if you're buying the Vanguard funds on the Vanguard platform. So I think that's probably one of the cheapest ways to index, if that's your thing. If not, if you're certainly more of a buy and hold investor, I think the Halifax platform, which I use, the Halifax share dealing platform, is very good. It has a fixed fee, no matter what the portfolio size is, of £12.50 a year. Recently, I think they've announced that it's going to go up to £36 a year, but it's still very cheap. And it's about £10 a trade. I think that's maybe going down a little bit. And dividend reinvestment, I think, is capped at £12 as well. So I think that's good, especially if you had a larger portfolio, because the fee is the platform fee is capped at such a low price. I think if you're going to be more of a regular trader, you've got platforms like Trading 212, which I also have, and they do an ISA. So that's obviously commission-free trading. I think they may make a little, I don't think the spread, I think that's a little not quite as competitive as some other platforms, but it's still pretty good. And I think they make their money largely through CFD trading. So assuming you're not doing that and not losing money, you can really get some great value out of Trading 212. But it is app only, so it's not something that is easy to go and print off your tax or whatever it might be, as either Halifax or Vanguard. And when it comes to sort of customer support, I think Vanguard and Halifax are pretty good. Sam?
Yeah, so I've got a ISA with Hargreaves Lansdown. And then on top of that, I've got an ISA with Hargreaves Lansdown. And I've also got an ISA with Halifax, because There are certain shares where, depending on how the transaction is settled, you can't actually buy them on Hargreaves Lansdown. So the example is Wix, which I bought a few weeks ago. You couldn't buy it on Hargreaves Lansdown. I think I asked them and they said it's because it's settled on the Swift network or something like that. But Halifax will let you do that, so I bought it in there. I do like Halifax. I just prefer the actual Hargreaves app, so that's why I moved everything over to Hargreaves. Before about 2 weeks later, I had to set up a new Halifax account just to buy Wix. In terms of Hargreaves, they're about £12.50 a trade, and they charge you, I think it's about 0.5% a year for ISAs as like a management fee, but they cap that at a certain amount. I want to say it's like 200 quid where they cap it. They've actually, so it's £12.50 a trade, but they've got a regular invest feature, which I actually only found out about from Brummy Investor on Twitter about a week ago. So if you've got a direct debit going out into your Hargreaves account every month, you can actually choose what that direct debit will be invested in, and you can change it each month. But if you do it so that you buy the shares as soon as the direct debit goes in, rather than putting it as cash in the account, it actually drops to £1.50 a trade. So I'm going to be doing that going forwards, but that's not what I've historically been doing. What about the second question then, John, where he's asked, I'll just get it back up. What research tools do you use for stock ideas, news and data?
So I suppose stock ideas, well, we've got a subscription to the Motley Fool, the UK edition, and that's UK Share Advisor. I know you use the Motley Fool, especially the Rule Breakers one, which you really enjoy, Sam.
Yeah.
Other stock ideas, I suppose, just reading the financial section in the newspapers. I have a Time subscription, so reading the business section, and I suppose market commentary. You can come across company sectors that you may be interested in, and then they'll announce when they have the results. They'll do a brief article on it, and then you can actually obviously just go onto the company's websites themselves and read the results and have a look at them there. That's something. Where else? Podcasts. So I quite like the Investors Chronicle podcast from a UK perspective. That's very interesting. So you can get ideas from there, and you can hear different. Sometimes they might interview different fund managers, stocks that they like, stocks that they don't like, different sectors. They would probably be some things, and then I guess things you see in your everyday life. If there's a business or something that services that you buy, that you use, you might think, well, I quite like that. I had a good experience. Is this company publicly traded? If it is, then that might be sort of an avenue to go and look at and explore further. And then I suppose I suppose as well, friends, you can talk to your friends about different companies, anything they're invested in, anything they're interested in. So that's another obvious source.
Yeah, I would add to that. I do, obviously. I enjoy the Motley Fool services. I've got the UK Stock Advisor and the US Rule Breakers. They'll give you, I think each service, it gives you a report every 2 weeks on a new company, and you also get each month the best buys now if they're existing recommendations. I think that's very good for building up a watch list. I think, I need to be honest, both of those services have a history of beating their market. So if you were to just choose from that pool of recommendations already, statistically, their average pick beats the market. So you're starting from a much better place than if you try and do it yourself. We don't have any affiliation with the Motley Fool, but I certainly think in terms of the amount of value I get out of my memberships, I think they're worth paying for. Another thing is, obviously, I mean, we do this podcast, but we then have to find the companies that are reporting. But the best way to do that, I find, is to just Google next week on the stock market HL, and Hargreaves Lansdown do an article every week where they just list every company in the FTSE 350 that's got results out and what those results are. So if you just scan that every week, if there's a company you're interested in, you know what day the results come out, and you can just go and get them. Equally, if you go onto the London Stock Exchange website, you can actually create an account and create a watch list, and you can set it so it emails you whenever there's results out as well. So that's another thing you can do. Podcasts, Yeah, I think on the UK side, I do like the Investors Chronicle. Each week they do what's called an Alpha podcast. I do think that's good. In terms of US, Motley Fool have their own podcast, so they're very good for US stocks news. So there's Motley Fool Money and Market Foolery. They've also got Rule Breaker Investing. It's actually the co-founder of the Motley Fool and the guy who runs the Rule Breaker service in the US. So he actually does a podcast every week. There's another podcast called Value After Hours, and that's a guy called Tobias Carlisle, who's a deep value investor, and two other value investors. So it's again US focused, but that's from a value perspective. And that's called the Acquirers Podcast, and that's very good. And also once a week, he usually interviews a fund manager or something like that. And then there's another US podcast called Chit Chat Money that I like, and it's basically, it was two college students, but I think they've left college now. But again, they're just talking about stocks, and they do like a deep dive. They do one deep dive a week into a US company, which is quite good as well. So yeah, there's probably like more resources than you can possibly reasonably consume. So I'd say just try lots of different resources, and you'll find some that you like and some that you don't. I wouldn't hesitate to drop the ones that aren't really working for you, because there's just such an abundance of resources now that you don't have to consume everything. You can just pick and choose.
Yeah. And I suppose in terms of strategy, there are lots of books. I think we've talked about some books before, but lots of books that can be influential on that. And if you've got a particular investment philosophy, then you may go looking for certain types of stocks when you're sort of scanning the market for companies that, may fit that sort of, or the criteria that you're looking for.
Yeah, I would add actually, yeah, that I think in terms of building your philosophy and your understanding of investing, I do think my personal view is that reading is crucial. I think. Yeah. I think you can only get so much from like Twitter and reading company results. I think there's some books where I think it should be required reading, to be honest.
I think it probably makes you a better investor and more maybe psychologically stable in terms of trade, because I think the temptation certainly now with, the platform that I mentioned, Trading 212, you can be tempted just to actually trade rather than to invest for the long term. Whereas if you have sort of an underlying philosophy behind your investing, you're probably less likely to be irrational.
Yeah, but in terms of books that I'd recommend, I think The Intelligent Investor is required reading, although that's quite dated in parts. Common Stocks and Uncommon Profits. Peter Lynch, One Up on Wall Street. What else? 100 Baggers by Chris Mayer, I think, is excellent. And
I'd say Malkiel of Random
Walk.
Malkiel,
A Random Walk. That's excellent as well.
The Little Book of Common Sense Investing by Bogle. I think that's very good.
Yeah, there's loads, but I think those are probably the classics. But there's certainly lots of others as well. Oh, the Ivy portfolio, I really enjoyed that. As well, actually. But yeah, that should keep you busy for a while anyway.
Yeah.
Right.
And make use of your ISA allowance this year.
Yeah. Right. Well, thank you very much for joining us, and see you all next week.
Thank you.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.